Something just changed in XRP that matters more than it looks. While the market focuses on price movements and short-term volatility, the deeper story is happening inside financial infrastructure, where institutions are building systems that could reshape how global value moves. In the next few minutes, we'll examine the banking investments, regulatory shifts, institutional positioning, and blockchain developments that are changing the XRP conversation. See, for years, the public message from major financial institutions was clear. Crypto was risky, speculative, and unlikely to transform finance. But the actions happening behind the scenes told a different story. While headlines focused on criticism and skepticism, some of the world's largest banks were investing heavily in blockchain technology, building private networks, hiring blockchain specialists, and testing new settlement systems. The important distinction is this. Institutions were not necessarily betting on every cryptocurrency. No. They were preparing for a possible transformation of financial infrastructure. And that is where XRP enters the discussion. Because the debate is no longer only about whether a digital asset can move value quickly. The bigger question is whether blockchain-based settlement can become part of the global financial system. And the signals investors are watching now are not just price charts. They are regulation, institutional adoption, liquidity, and real-world usage. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. Thank you always to everyone who likes and shares each of our videos. These two things really do help out the channel. I hope you enjoy the content. See, JP Morgan became one of the largest institutional players in blockchain development. Over the last decade, the bank built significant blockchain capabilities, including enterprise-level settlement systems and digital asset infrastructure. The company developed its own blockchain-based platforms designed for institutional transactions. Let that sink in. This was happening while public discussions around cryptocurrency remained highly skeptical. That contradiction created confusion. Why would a company invest billions into blockchain technology while executives question the value of cryptocurrency? Riddle me that, Batman. The answer is simple. Large institutions rarely think in headlines. They think in decades. A bank managing trillions of dollars does not ask, is this technology popular today? Could this become necessary tomorrow? And that is the difference between speculation and infrastructure. Short-term noise, long-term structure. The market often focuses on price movements. Institutions focus on systems. And historically, major financial transitions have often started this way. In the 19th century, the telegraph transformed global commerce. Before the telegraph, financial information moved at the speed of physical transportation. A message between continents could take days or weeks. The telegraph changed that. Suddenly, information could travel almost instantly. Financial markets expanded because speed created new possibilities. Banks, businesses, and governments adapted because they understood something fundamental. When communication infrastructure changes, financial systems change with it. Blockchain supporters argue that digital settlement could represent a similar transition, not because it replaces every institution overnight, but because it could change the speed, transparency, and efficiency of moving value globally. The question is not whether every old system disappears. The question is whether the new system becomes too efficient to ignore. This is where XRP enters the discussion. One of the strongest arguments made by the supporters of XRP is transaction efficiency. The example frequently discussed is a large XRP transfer completed rapidly and at a very low cost. The significance is not simply the transaction itself. The bigger point is what it demonstrates. A blockchain network could potentially move large amounts of value quickly without relying on traditional correspondent banking systems. Today, international payments often involve multiple intermediaries. A cross-border transfer can pass through several financial institutions before reaching its final destination. Each institution adds complexity. Each step can create delays and additional costs. The argument behind blockchain settlement is that the process could become more direct. But here's where investors need to separate technology from adoption. A faster payment network does not automatically mean global adoption. No. The technology must still overcome regulation, institutional risk concerns, integration challenges, competition from other payment systems. The technology may exist. The question is whether the world adopts it. And that is the battle happening today. Now, this is what most people miss. Financial institutions rarely adopt new technology simply because it is interesting. They adopt it when the competitive pressure becomes impossible to ignore. Imagine one major bank creates a significantly faster and cheaper settlement system. At first, competitors may dismiss it, But eventually customers notice. Businesses begin asking, why does my competitor receive payments instantly while mine takes days? That creates pressure. The banking industry has always operated this way. Technology spreads when the cost of ignoring it becomes greater than the cost of adopting it. A similar transformation happened during the rise of online banking. At first, digital banking was optional, then customers demanded it. Eventually, every major institution had to adapt. The same question is now being asked about digital assets and tokenized finance. Will blockchain become another optional tool, or will it become a core financial layer? See, one of the most closely watched relationships in the XRP ecosystem has been Japan and SBI Holdings. SBI has maintained a long relationship with Ripple and has become one of the most visible institutional supporters of blockchain-based financial infrastructure. Japan has historically been one of the more active countries when it comes to exploring digital assets, regulation, and financial innovation. This matters because Japan is not a small financial market. It is one of the largest economies in the world, and major financial institutions rarely happen through individual investors alone. They happen when governments, banks, payment companies, and infrastructure providers begin moving in the same direction. But the real shift came when regulation started catching up, because institutions do not operate purely on technology. They operate on legal certainty. For years, one of the biggest barriers facing digital assets was uncertainty. Institutions can tolerate volatility. What they cannot tolerate is unclear rules. Banks need to know what assets can they hold, what transactions are permitted, what compliance requirements exist, who has regulatory authority. This is why regulatory developments have become such an important part of the digital asset story. See, in the United States, proposed legislation aimed at creating clearer digital asset rules has become a major focus for the industry. Supporters argue that clear regulation could encourage institutional participation. Critics argue regulators must move carefully to protect consumers and financial stability. Both sides recognize one thing: the current uncertainty cannot continue forever, because financial innovation does not stop waiting. It simply moves somewhere else. I want you to think about the internet, which provides one of the strongest comparisons. See, in the early days of the internet, many businesses underestimated its importance. Some viewed it as a niche technology. Others saw it as the foundation of a new economic system. The companies that adapted early gained enormous advantages. The companies that ignored it eventually had to catch up. Blockchain advocates believe digital assets could represent a similar infrastructure transition, not because blockchain replaces the internet, but because it may become another layer built on top of it, a financial internet, a system where assets, payments, and ownership records can move digitally. The winners of these transitions are often not the people predicting the future perfectly. They are the ones positioned for multiple possible outcomes. One of the biggest arguments surrounding tokenization is the size of the traditional financial system itself. Global financial assets represent an enormous market. Some executives in the digital asset industry have described the opportunity using numbers reaching into the quadrillions. The idea is not that all global assets move onto one blockchain overnight. No, that would be really unrealistic. The argument is that even capturing a small percentage of global financial activity could represent a significant market. Let this sink in. It's very important. This is why institutions are interested in tokenization. Stocks, bonds, real estates, private assets, settlement systems. All these areas are being studied. But again, potential does not equal certainty. Again, this is very important. The technology may create opportunities. The market must still decide how much adoption actually occurs. When people discuss XRP, most conversations immediately focus on one thing: price. Where could it go? What is the next target? How high could the market value become? But institutional investors often look at something different. They look at function. They ask, what role does this asset play inside a financial system? And this is where the conversation around XRP becomes more complex, because supporters argue that XRP's potential is not only based on transaction speed. They argue the bigger opportunity is its possible role as a bridge asset and liquidity tool inside a future digital settlement system. This is the part many retail investors overlook: the difference between an asset that is simply traded and an asset that institutions may actually need to use. Because if a digital asset becomes part of operational infrastructure, their demand dynamics could look very different. But here's where investors need to remain disciplined. Technology alone does not guarantee adoption. A network can be fast. A network can be efficient. A network can solve real problems. But institutions still need reasons to integrate it. They need regulatory clarity. They need liquidity. They need security. They need confidence that the system will exist for decades. And that is why the institutional race is not simply about technology. It's about trust. Now, this is where the conversation becomes very interesting. Many investors focus on utility. How many transactions happen? How many payments move? How many users exist? Those metrics matter. But financial markets have another powerful driver: collateral. Collateral is the foundation of modern finance. Banks do not simply move money. They manage liquidity. They manage reserves. They manage assets that support financial operations. See, if digital assets become integrated into institutional finance, some analysts argue that certain assets could develop a new role, not as speculative investments, but as financial instruments used within the system. This is why some XRP supporters focus on institutional holdings. The argument is that if banks, payment companies, or financial institutions eventually require digital liquidity pools, demand could become more structural. The key word is eventually, because the market is still developing. The infrastructure may be forming. The question is how quickly adoption occurs. Short-term noise, long-term structure. Another major development being watched is the growth of stablecoins and tokenized assets. Let that sink in, ladies and gentlemen. Stablecoins are designed to represent digital versions of traditional currencies. They allow value to move on blockchain networks while maintaining a connection to existing monetary systems. Ripple's RLUSD stablecoin has become part of this broader discussion. Let this sink in. The argument from supporters is that as more digital assets and stablecoins operate on blockchain networks, activity on those networks could increase. And if XRP Ledger becomes a platform for financial applications, XRP's role as the native asset of the network becomes part of the conversation. This is especially relevant because tokenization is one of the biggest themes being explored by institutions. Imagine financial assets represented digitally: government bonds, corporate debt, real estate ownership, investment funds, private assets. Instead of transferring ownership through traditional databases, these assets could potentially exist on programmable digital infrastructure. Let this sink in, ladies and gentlemen. It's massive. Now, this does not mean every asset moves onto blockchain tomorrow. No, that is unrealistic. But the direction is what institutions are studying, because even a small percentage of global assets becoming tokenized could create a significant shift. A similar transition occurred during the Industrial Revolution with electricity. When electricity first emerged, many businesses viewed it as an improvement to existing systems, but eventually became much more than an upgrade. It changed the entire structure of production. Factories were redesigned, cities transformed, entire industries emerged. The biggest winners were not necessarily the companies selling electricity. They were the companies that understood what electricity enabled. A similar debate exists today around blockchain. The question may not be which blockchain wins. The deeper question may be what industries change because blockchains exist. Payments, finance, asset ownership, baby, settlement. The infrastructure underneath the economy could evolve. And history shows that infrastructure changes often create the largest opportunities. Europe has become one of the most important regions in the digital asset regulatory landscape. The introduction of comprehensive crypto regulation has been viewed by many institutions as a major step towards creating clear rules. For financial institutions, regulation is the foundation. Banks cannot build billion-dollar systems on uncertainty. They need frameworks. They need licensing standards. They need compliance requirements. This is why regulatory developments are so important. The companies that operate successfully in regulated environments may gain a major advantage. And this is where Ripple supporters believe the company's institutional focus becomes significant. Rather than targeting only retail speculation, Ripple has spent years positioning itself around financial institutions and payment infrastructure. And whether that strategy succeeds remains an open question. The approach is clear. Build relationships, work with regulators, create institutional products, prepare before mass adoption arrives. The United States remains one of the most important markets in global finance. American capital markets influence the world. Major investment firms, banks, exchanges, and technology companies operate from the United States. That is why digital asset regulation in America matters so much. A clear regulatory environment could potentially unlock greater institutional participation. The industry has repeatedly argued that uncertainty has slowed innovation. Meanwhile, regulators have emphasized the importance of consumer protection and financial stability. See, the debate is not unique to crypto. Every major financial innovation has faced a similar challenge. How do you encourage innovation while managing risk? The answer usually comes through regulation, not eliminating change, but creating rules around it. Now, this is the part investors need to consider, ladies and gentlemen, because every major investment thesis has risk. The first risk is regulatory uncertainty. Even if digital assets gain acceptance globally, specific projects may not benefit equally. Competition is another factor. XRP is not operating in isolation. There are multiple blockchain network payment systems and financial technologies competing for institutional adoption. The third is execution. This is the biggest risk as far as I'm concerned. A technology can have potential and still fail to achieve widespread adoption. History is full of examples. Many companies created revolutionary products. Only some became dominant. Being early does not guarantee being successful. And this is why investors should separate a strong technology thesis from guaranteed outcomes. The opportunity may be significant. The risks are equally real, ladies and gentlemen. So what should investors actually pay attention to? Not every headline, not every social media prediction, not every short-term price movement. The important signals are structural. Watch institutional participation. Watch regulatory progress. Watch real-world usage. Watch whether financial companies move from experimentation into implementation, because markets often misunderstood early adoption cycles. At first, there's skepticism, then experimentation, then infrastructure build, then if successful, mainstream adoption. The challenge is identifying which stage we are actually in. See, the most important takeaway from this entire discussion is not simply XRP. It is a transformation happening underneath the financial system. Money is becoming increasingly digital. Assets are becoming increasingly programmable. Settlement systems are being redesigned. Banks are exploring new infrastructure. Governments are creating new regulatory frameworks. The financial system of tomorrow may not look like the financial system of yesterday. No. And this is why institutional behavior matters. Because institutions often prepare before the public understands the change. They build quietly. They test privately. They adapt slowly. Then suddenly everyone notices. At the beginning of the automobile era, many people believed horses and traditional transportation would remain dominant. Cars were expensive. Infrastructure was limited. The technology was imperfect. But the underlying innovation solved a fundamental problem: speed, efficiency, scale. Eventually, the entire transportation system changed. Not overnight, not because everyone woke up one morning and agreed, but because the new system became more practical. Blockchain advocates believe digital settlement could follow a similar path, not replacing everything instantly, but gradually becoming the preferred infrastructure for certain financial activities. The question is whether blockchain reaches that point. The three things investors should remember, ladies and gentlemen. First, the institutional blockchain movement is real. Regardless of individual cryptocurrency options, the largest financial institutions in the world have invested heavily in blockchain research and infrastructure. Second, regulation is becoming the critical factor. Technology alone is not enough. The winners will likely be the networks and companies that can operate within global financial rules. Third, the future of digital assets may depend less on speculation and more on integration. The biggest opportunities often appear when technology moves from being interesting to being necessary. So for years, investors have been watching the crypto market through one lens: price. But the bigger story may be happening somewhere else, inside banks, inside regulatory systems, inside financial infrastructures. The question is no longer simply, do institutions believe blockchain exists? They clearly do. The question is, how deeply will blockchain become integrated into global finance? XRP supporters believe the network is positioned for this transition because of its focus on payments, liquidity, and institutional settlement. Skeptics argue adoption still needs to be proven. Both perspectives matter because the future is not built through hype. It is built through adoption. Short-term noise, long-term structure. Prices react and the system's evolving. Ladies and gentlemen, investors who understand that difference are usually the ones who see major transformations before they become obvious. If you found this analysis valuable, make sure to subscribe to the channel, leave a comment with your thoughts, and let me know. Do you believe blockchain will become the next major financial infrastructure layer, or will traditional systems adapt without needing a major disruption? Because the next decade of finance may be defined by that answer. I hope everyone's having a blessed afternoon, ladies and gentlemen. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. What a day. What a 2 days. I want to wish a very happy belated birthday to Matthias. Happy birthday, brother. Happy belated birthday to Mike. Love you guys. I also want to say a big shout out to Mike over in the UK. Fantastic conversation today. Fantastic conversation today. Ladies and gentlemen, I want everyone to understand right now what I mean by getting caught up like sushi. Because people are getting caught up like sushi. You saw all Wall Street getting caught up like sushi. We weren't able to make a video yesterday because when we're right with our assumptions, we take a lot of time to talk with clients, family offices, funds, the families, because people are very, very happy and relieved that we were right. At the end of the day, you have to understand something. The narrative you saw that led the market to rally, the Harry Houdini freak show ended. The market stopped thinking about there were going to be higher interest rates. Yay! Everybody runs into positions. Gold, silver, boom, platinum, palladium, boom, go higher. I told you in the last couple of videos, we were positioned for these. Bitcoin hit 65,000. Then all of a sudden, some numbers come out today. No bueno. Interest rates could be higher. The Fed Reserve Chair says we might have to raise interest rates. And you see in 48 hours the most magnificent carnage ever. Ladies and gentlemen, if you want to take advantage and be first mover advantage in the metals market, gold, silver, platinum, palladium, equities, come and join the Crypto Public Desk Monthly. Join over 650 active traders, investors who are taking their destiny into their own hand. One good tip in the pits can easily pay for your entire year subscription. So if you're looking for that deeper macro research, you want to learn how to take advantage of this, come and get your Gucci conviction on with the rest of us, because we're sitting here feasting on the sushi. Feasting. 5 of our plays hit their targets. We're in and out. But this is what you're seeing right now, ladies and gentlemen. People are getting carried out in body bags and stretchers here right now. You got the ground war in Yemen getting ready to reignite. There's going to be an assault on the Houthis. Ladies and gentlemen, the Harry Houdini freak show is the craziest freak show I have ever seen in my financial career as a mercenary. So we're seeing right now liquidity get sucked out of XRP, ICP, Bitcoin, and it went into metals. We saw a rip your face off rally. It went into other things. You saw oil make a move. DXY made a move. But all of a sudden in 48 hours, like the wind blows, like a tweet, Fed chairman said we need to raise interest rates. Talk about throwing a cold towel on something, right? There's the sushi for you. You cannot lose your Gucci conviction here right now. There is no liquidity in the market right now. This is what's sucking assets down. The path of least resistance is down right now. But I got another question with our thesis here, ladies and gentlemen. Our thesis here, again, the AI battle. The last video we spoke about China coming out being cheaper than the US. I have a different argument about, does open AI or closed AI win the battle? Let me see in the comments what you think is going to win or what not. But make no bones about it. See, we don't think, we're in the camp that kinetic action does not end in the Middle East. We are in that camp, ladies and gentlemen. We don't think the Iranians want a deal. I'm going to come out and say this. None of this is financial advice. It's my own opinion, and it retains any capacity. Again, educational and informational purposes this video is for. We don't believe the Iranians want a deal or peace. To have a deal, you got to have a negotiating partner that kind of values what you value, that kind of wants something that you want, and vice versa, and you come to the middle, 50%, 50%. That's a true negotiation, right? There is no negotiating with someone who does not want peace. There's only buying time. And as they buy time, they learn how to asymmetrically fight this battle. What does that do for us as financial mercenaries? Very important lesson here, ladies and gentlemen. First off, do not get shaken out of this. No leverage. Do not play with leverage right here, right now. Playing with leverage here right now is like barbecuing on the beach, on the sand, and not realizing if your barbecue is on the sand and you go walk on the sand where you put the barbecue, you'll go into the hospital and get third-degree burns on your feet. Gucci conviction, Gucci clarity here right now. We understand the conflict is this. We follow our thesis. First, we don't believe the Iranians want peace. Boom. Follow RBUB, follow crude oil. Understand that if metals begin to rally, the Fed will come out and throw cold water on this. If the information that is released allows them to do that and give them cover, hallelujah. They did that today. So in 48 hours, see, we're out of our gold, we're out of silver, our trades, not our physical. Never get rid of your physical, but our trades, we are clear. We took profit. Pigs get slaughtered, hogs get fatter. But this is the narrative, ladies and gentlemen. If you want to be first mover and take advantage of the next epic proportional move that's going to come from this Harry Houdini freak show, come and join the Crypto Public Desk Monthly. Join over 650 active traders. Our members see anywhere between 50 and 150% return on their money, depending on what tip from the pits they take. Ladies and gentlemen, it's that easy, because this is going to continue to keep on going. Again, I want to be here every day making videos, but we simply can't. I want you to understand something. Write down the things I'm saying. It all makes sense. Do you know why it makes sense? I want to hear in the comment section, do you know why it makes sense? I know why it makes sense. But at the end of the day, nothing makes sense except green candles or red candles, as long as you're positioned in the right way. But this is what we're living with now and living through, ladies and gentlemen. This is it. Most people aren't talking about, things that we're paying attention and tracking to. But understand this right now. Downside is here. But that's not forever. Because institutions are now preparing for the new tomorrow. We're in the camp that Clarity Act gets voted on and passed. I'm going to keep saying this, and if I'm wrong, I'll eat my hat and say I'm wrong. But that's what I believe. But that has no determination on where we're going to go with this. The CFTC and the SEC will write rules. Look at XRP today getting the thumbs up out of Europe for their MiCA regulation now. Throughout all of Europe, coming out of Luxembourg, Liechtenstein, lovely. Russia's got regulations in there. The United States is going to have it. But again, as financial mercenaries, not to get caught up like sushi. We're watching the war. Why I say we've got this dialed in, because once we understand what's happening and why, there you go. And ladies and gentlemen, on days that we don't make videos, come and join us in the Crypto Public Desk monthly inside of our Patreon. We're always there putting out content, because at the end of the day, I love everybody here. I want everyone to get to their goals. You have to understand today's world is not fair. It's not. Not at all. Understand that change is coming. Are you going to be ready? Will you be ready? Because the narrative's here. The war will heat up. They're just buying time. Ladies and gentlemen, the United States has to print ourselves out of this situation. The Rip Your Face Off rally will be coming before anyone knows it. And it's not going to announce itself. And when that happens, I got something to say that's very, very important, okay? I got something to say. My phone's ringing here. It's so funny. I got something to say. People talk about market caps. They talk about all these things, right? They're beautiful. They're wonderful. They're lovely, right? They mean un gats. They mean un gats. You know why they mean un gats? Remember when George Lucas sold all the rights to Star Wars and all that other stuff to Disney? He sold it for $1 billion. When he sold it for $1 billion, people were like, oh my God, it's $1 billion. Wow, it's $1 billion. A lot of money back then. Today's world, what that's worth, $1 billion is nothing. There's a trillionaire. When they print money, no one cares about market cap and these things. It's not going to matter. So stop looking at where we're going backwards through binoculars. Prepare for the Gucci conviction, the Gucci clarity, as we walk up this frosty mountain with our frosty beverage, because change is coming, ladies and gentlemen. And whether or not you see the top of this mountain is whether you got the conviction to hold. Don't get caught up like sushi. Ladies and gentlemen, this video is for entertainment, educational purposes only. This is not financial advice. Always consult a licensed financial advisor. Never, ever, ever invest a single dollar from watching a YouTube video ever. Don't ever do that. Never invest money from watching a YouTube video. I love you all, ladies and gentlemen. I'm going to see you on the front lines.